Silicon Valley Bank collapsed after years of risky practices, leaving thousands of employees without pay and growing fears of an economic crisis. Welcome to America Uncovered. I'm Chris Chappell. Last week, after 40 years of operation, Silicon Valley Bank suddenly collapsed. It took less than 2 days. It was the biggest U.S. bank failure since the financial crisis of 2008, and the second biggest U.S. bank failure in history. The only bank that fell harder was Washington Mutual during the 2008 financial crisis. Silicon Valley's bank's collapse happened just a day after Silvergate Bank, which focused on the crypto industry. And it was immediately followed by Signature Bank, which became the third largest U.S. bank failure. Not the type of records you want to see set side by side. I'd much rather be reporting on how the U.S. broke its record for the second and third most belly rubs in a single week. Oh, who's a good boy? You are. Yes, you are. It's ironic, not too long ago, SVB's holding company was in the Forbes Financial All-Stars list. And SVB's UK arm was up for Bank of the Year at a London gala. Silicon Valley Bank was set up in 1983 and rose to be the 16th largest bank in the US. Some of its clients included the likes of Pinterest, Etsy, Shopify, Roku, and Vox Media. I mean, it had Silicon Valley in the name. Of course it was the go-to bank for Silicon Valley tech companies. Makes me think with the right name, I could start my own big business. I know, I'll create the Billionaire Store. Was it sell? I'll figure that out later. With a name like this, it's going to attract the richest customers. As a result of SVB's collapse, thousands of accounts couldn't wire funds out. Many companies couldn't pay their employees, and other banks lost billions of dollars in value. Have you ever failed so bad at your job that you caused other people to fail at theirs? When I used to work at Wendy's, I sometimes screwed up orders, but I never screwed them up so bad that people at Arby's were left without pickles. In response, California's state banking regulator took over the bank on March 10th, and SVB was put under the control of the Federal Deposit Insurance Corporation, or the FDIC. You know it's bad when the government steps in. The FDIC insures bank deposits of up to $250,000, meaning if you have up to $250,000 in one bank account and the bank goes under, the federal government guarantees you'll get your money back. But most of SVB's customers are companies, and they had a lot more than that deposited in their accounts, which means they weren't insured by the FDIC. According to one analysis, almost 94% of SVB's domestic deposits were uninsured. To give you an idea of how unusual that is, only about half of the deposits in most banks are above the FDIC limit. That means that if SVB failed, 94% of their depositors probably wouldn't get their money back. Normally. But there was a lot of pressure on the U.S. government to bail out SVB to prevent a larger run on the banks. On Sunday, U.S. Treasury Secretary Janet Yellen said there would be no bailout. Here's an actual photo of Yellen making that announcement. To be fair, there was a lot of pressure on the U.S. government not to bail out the bank, too. Turns out the taxpayers don't remember the 2008 bailouts too fondly, which used taxpayer money. So what did the government do? It announced that it would protect all SVB deposits, even beyond the federally insured ceiling of $250,000. It also announced that it would make funding available for other financial institutions in the form of one-year loans. Is all of this a bailout? It depends on who you ask. The Biden administration claims it's not a bailout because the investors in SVB are still losing all their money. But some are still calling it a bailout because all the depositors in the bank are getting their money back despite the federal insurance limit. President Biden also said no losses will be borne by the taxpayers, which is optimistic. Since when the government is involved, taxpayers always wind up paying for everything, due to the tendency of bureaucrats and politicians to treat the fruits of citizens' productive labor like a giant personal piggy bank that says, break in case of financial mismanagement. But this time, it's technically true. in that the SVB deposits will be paid out through the FDIC's Deposit Insurance Fund. That's mostly money that banks pay to the FDIC in fees in order to be insured. And if they need to top up that fund, they'll add a special assessment on banks, aka more fees. But according to one Brookings Institution analyst, banks are likely to pass on those fees to customers, which means Main Street banks in America and their customers are bailing out the tech firms and cryptocurrency giants who had uninsured deposits at Silicon Valley Bank. So see, not taxpayers, just average American bank customers. Meanwhile, SVB is putting up for auction, and Biden spoke up and assured Americans that the banking system is safe. Like I said earlier, all of this is to prevent a bank run, which happens when a ton of customers suddenly try to withdraw all their money at once and the bank doesn't have enough money to cover it all. A bank run also sounds like the name of a pub crawl, but for armed robbers. And a bank run is also part of what happened at SVB. So, what went wrong? What exactly led to SVB collapsing so quickly? And was this preventable? I'll get to that after the break. Welcome back. The sudden collapse of Silicon Valley Bank has the news cycle reeling. It's an ongoing story, but how did we get here? I mean, most of us never even heard of Silicon Valley Bank before last week. So how is it the second biggest U.S. bank failure of all time? Is this just a simple case of get woke, go broke? Well, you know what they say. For every complex question, there is an answer that is equal parts simple, elegant, clear, and wrong. And the SVB collapse is complex, so let's get into it. For years, the U.S. experienced a tech boom fueled by low interest rates set by the Federal Reserve. That made it easier for companies to borrow money and for venture capitalists to raise funds for their pet projects. Do you think NFTs came from someone who didn't have cash to spend? This isn't the type of idea you risk it all on. Tech companies especially enjoyed major profits during the pandemic. But with so much cash coming in, companies had to put their profits somewhere, and I don't think they're considering stashing it underneath their mattresses. Which is a shame, because the only thing better than an extremely expensive and insanely comfortable mattress is an extremely expensive and insanely comfortable mattress sitting upon billions of dollars in cash. What? Well, how do you sleep at night then? While distinctly less cool than sleeping on top of your swag, banks are the go-to solution for stashing money. And for tech companies, there was one that stood out: Silicon Valley Bank. During the pandemic, banks across the board took in record volumes of new deposits. Between the end of 2019 and the first quarter of 2022, SVB's deposits more than tripled to $198 billion. But that growth was never going to last. Thanks to a post-pandemic cool-down and rising interest rates, tech startups began to tumble, and established tech companies began to retract. Wait, you mean NFTs were just a fad? I thought they'd be cool forever, like MySpace, Pogs, and MySpace Pogs. These are probably worth a fortune still, right? Right? The drop was huge. By the end of 2022, SVB had total assets of approximately $209 billion and total deposits of over $175 billion, which sounds like a lot, but that's $23 billion less than it had at its height. And that's a lot of red on the balance sheet. See, one thing that's important to understand about banks is that on their balance sheet, deposits are actually negative. Why? Because the bank pays clients interest on their deposits, which means the bank loses money on them. So how does a bank make money? By taking those deposits and buying things with them that are profitable, things like stocks, bonds, and other securities. Or they use the money to give out loans because on their balance sheet, the interest from those loans is, well, money in the bank. But the problems began with SVB's business model. For one, the bank was too focused on a niche industry. SVB tried to stand out from other banks by catering to startups, especially those involved in tech and life science. That's riskier than investing everything you own in a timeshare sandcastle mansion in Florida during hurricane season. Sure, it seems valuable now, but tick-tock. Most startups are, well, starting up, which is a challenge in of itself because they don't have track records to prove to banks that they can make consistent profits, or even any profits at all. Expecting big revenue from startups is like expecting a big salary as an improv comedian. You're lucky if you make drink tickets and a hot dog. Given that a majority of startups fail and aren't profitable, traditional banks are very hesitant about putting money into them, let alone making a huge chunk of their income depend on them. SVB was different. It was willing to provide loans through venture debt. That is, giving loans to startups that were already backed by venture capital. Venture debt allows startups to keep burning through cash for projects that will just maybe turn a profit. Eventually. Someday. In the perceivable future. Hopefully. Sounds risky? It is. But SVB wasn't just providing loans to venture capital-backed startups. It was a huge part of the venture capital system. According to its website, SVB banked nearly half of all U.S. venture-backed startups. And its clients include 44% of the U.S. venture-backed technology and healthcare companies that went public. That means these startups kept their money in SVB. SVB also held deposits for and gave loans to lots of venture capital firms, the companies that were funding these startups. It also invested in a lot of venture capital funds and startups. All of this would come back to bite them, along with SVB's second big problem, how they were making money. I'll tell you more after the break. Welcome back. To make money, SVB took in tens of billions of dollars from its venture capital clients and then, confident that interest rates would stay steady, plowed that cash into longer-term bonds. Basically, they took the money from these bank deposits and used it to buy 30-year mortgage-backed securities and treasury bonds. Treasury bonds especially are seen as very safe and secure. They're an even safer investment than MySpace Pogs, which are going to make me a fortune, right? Right? But what if, say, there was inflation, and the Federal Reserve tried to fight it by spiking interest rates? That's what the Fed did. They've been practically screaming about it over the past few years. The problem is, as interest rates went up, the value of these long-term treasury bonds went down, way down. As a result, SVB's portfolio lost $15 billion in value. That's because no one wants to buy those treasury bonds with their low interest rates anymore. Now, Silicon Valley Bank held on to the bonds until they matured. They would have been okay. Unfortunately, SVB found itself in a situation where it needed to sell their bonds at a loss. Apparently, as a bank, you can't tell your customers, just wait 20 years and this will all blow over. That's more likely to make them want to go on both types of bank runs. Here's where SVB's venture capital involvement came back to bite them. Thanks to high interest rates, venture capitalists stopped throwing money around, and venture capital-backed startups had to withdraw more of their money from SVB to pay for their cash-burning expenses. But SVB didn't have enough cash for these higher-than-usual withdrawals. It mostly just had a lot of securities and bonds which couldn't be easily exchanged for cash without losing a lot of money. After seeing SVB's deposits drop fast in February and March, SVB Financial Group CEO Greg Becker decided to liquidate almost all of the bank's portfolio. On Wednesday, March 8th, SVB Financial Group announced that it had sold $21 billion in securities, but in doing so, it lost $1.8 billion. During the same announcement, SVB shared a plan for a $2.25 billion share sale to shore up capital, aka to get more money, which it was running out of. This was a huge red flag. After that announcement, Moody's Investor Services, the risk management agency, downgraded SVB's credit rating. Meanwhile, investors such as Peter Thiel's Founders Fund advised its clients to withdraw money from SVB. And word spreads fast in Silicon Valley. More people started withdrawing their money from SVB. On Thursday, March 9th, Becker told people at a conference to stay calm, which is honestly the worst thing to say. If you got to tell people to stay calm, then that just screams do the exact opposite, which is what happened. So many people panicked that customers tried to withdraw $42 billion that day, a quarter of the bank's total deposits, a textbook bank run. Basically, there was no way SVB could get enough cash on hand to pay out all those withdrawals. SVB raced to find a buyer, but regulators weren't willing to wait. With the bank unable to satisfy all the withdrawal requests, the government made its move. This was like the most complicated and frustrating ending to a game of Monopoly ever, which, if you've ever played Monopoly, is really saying something. The rest is history. Good thing CEO Becker was able to sell $3.6 million worth of shares just a few weeks before this happened. Imagine the luck of that guy. Some are blaming SVB's failure on Trump for signing a law that rolled back Obama-era banking regulations. They say that paved the way for SVB's collapse. It's true that there was a rollback of regulations during the Trump administration, a rollback that passed Congress with a bipartisan vote. So it was hardly Trump doing this one-handed. The rollback meant that smaller banks like SVB didn't have to pass stringent stress tests and liquidity requirements anymore. Those tests were supposed to guarantee banks had 30 days of cash on hand to pay back depositors. But also, it's not clear it would have made any difference. According to the Bank Policy Institute, SVB would have still passed those tests anyway. The bank run was just so big, there's no way SVB would have been able to handle it even with 30 days of cash on hand. In the end, SVB's risky bets should serve as a warning, especially when you're dealing with Silicon Valley startup dudes. You have to be more careful when starting a business, and only invest in sure things. Like my billionaire store. It can't miss. So what do you think of Silicon Valley Bank's collapse? Leave your comments below. And if you like this show, remember that we rely mainly on direct support from viewers like you. All it takes is as little as $1 per episode over on our crowdfunding website, Patreon. Visit patreon.com/America Uncovered for more. Click the link below. Once again, I'm Chris Chappell. Thanks for watching America Uncovered.